Good morning, good afternoon, and welcome to Develop Your Edge with Anthony Crudele. I'll be your co-host, Tom Schneider, CMT with NinjaTrader. Before we get into the show, I do want to remind everybody that futures and options trading contains substantial risk, is not for every trader. You could potentially lose all or even more than all of your initial investment. That's why we recommend you use risk capital. What is risk capital? It's money you can afford to lose, doesn't keep you up at night, doesn't extend your retirement horizon. I also want to remind everybody that past performance is not necessarily indicative of future results. And what we talk about here in this program contains neither trade recommendations nor financial advice and should be used for educational purposes only. With that out of the way, it's my pleasure to welcome back to the show, of course, every Thursday, Anthony Crudele coming to us from Florida. How you doing, Anthony?
I'm doing great, Tom. Glad to be here.
Yeah, good to see you. Everything looks bright. Everything looks pretty positive. Interesting weeks that we're living in. How you doing?
I'm doing great, and I'm really excited for today's show as we're going to talk about as I look down at my notes and is a range of execution versus just looking at a single price. And you and I both know, I mean, obviously you on the technician side, you look at a lot of these areas of importance and you, from your past of watching it, you know that one single price is never going to be really it's not going to no market's ever just going to touch that price and just hold whether you're getting in or getting out. And so when we talk about a range of execution today, I think it's really going to open up the eyes of a lot of traders and understand just a real simple rule that I go by when it comes to using range of execution versus just looking at a single price.
Yeah, I mean, I've always thought that the reason for that, when we see levels on our charts, and again, we use charts pretty extensively to know where the market is and where it could go. You use those levels as guides, and you and I, being different traders, we might have a different approach. If you see a level, you might want to get to that level before you might want to get a price before it hits that level, or even after, depending on what your risk profile is, whatever your situation. How are you feeling about the trading day, right? You want to get that price, you want to get in before it, or maybe, yeah, I'm okay. I can wait a little bit later. So they're just guides, but I agree with what you're saying wholeheartedly.
Let's pull it back, traders, and let's talk about the things I'm going to focus on today. We're going to talk about position sizing. And when you look at markets, one of the things that I think are key elements to growing as a trader is adjusting your position size according to the context of the situation, right? We're not just always in the same position size in every single trade. We're not just going to go all in at one price. And adjusting your execution within a range is of extreme importance. And when you think about executing as a trader, I think especially when you're looking at day traders, you're looking at a range of execution because of scaling. And you're able to see how the market reacts to a level by inching your way in and inching your way out. I mean, if you just want to buy a stock and you have a stock that you want to get in, and you might be getting in, 10, 20, 30, 40, 50% at a time, you're scaling based upon just that price and you're doing it over a long period of time. So as an investment, you always think to yourself, well, I'm just going to buy the market right here because it's a stock I want to be in, and you might just pick a price and do it. When you're getting into futures markets, it is a whole other ball game because there's so much more volatility and you're trading on such a shorter time frame that you don't want to be all in at one price. I mean, there might be some situations where you actually would do that, and I'll probably touch base on that. But most of the time, it's something that you want to, I hate using the word feel, but it really does come down to that. And the reason is because when you look at the range of execution versus a single price, look at the NASDAQ or the gold market, which I'm actually going to go into and follow up in the gold market today on some of the technical analysis that I did over last week's show. And those markets, they trade through a lot of prices. And when they get volatile, if you're in at one price, you're basically going in and you're hodling, holding on for dear life, right? And because those markets, they might run through prices and you just hope it doesn't get your stop. To me, that's not really being a trader. That's just really somebody who's just following a strategy. And ultimately, if that's what you want to do, you just want to be all in at one price. I would recommend just looking at automation, because I wouldn't really classify yourself as, a day trader. And I don't mean that really in a negative connotation towards anybody, but I think that you're probably just better off doing that if you just want to be in at one price, because maybe that's the way you feel. But I think if you want to try and be a trader, and you want to try and become a better trader, and you want to develop your edge and work on your execution, then trading everything at one price is really just not the path that you want to be on, because you're too price sensitive. You're too price sensitive in, you're too price sensitive out. How many of you out there have looked at a market and said, I think it's going to come to this area. I want to buy it here. I want to sell it here. It comes a tick short. You don't get filled, or it comes a buck short from that price. You don't get filled. And next thing you know, you go from having a winner where you almost made some money on it, or you would have made good money on it, to where you're scratching it or losing or making a little bit. It happens regularly. And you almost can't believe how good you are as a trader sometimes when you pick the tick. And for me, I learned that in order to really excel and get to the next level as a trader, this single rule I'm going to share with you right now, to me, is one of the most impactful things that have happened in my career. When we are in a bull or bear trend in a market, and you're going to identify that whichever way that you want, based upon whether it's opening range. I talk about opening range on a 3-minute chart with a VWAP. Somehow, some way, you're going to identify what type of trend the market is for that specific day or time frame. Once that's identified, a bull or bear trend, here's the rule that I follow. In a bull trend, my range of execution, if I want to be long, is I buy at and above prices. That means that when the market comes down to a level that I'm looking at and I am bullish, and we get near that level, I start to scale in above that level, and I will scale down to that actual price. And the reason why you do that in a bull trend when you're buying is because a lot of times in bull trending markets, the market never gives you an opportunity to get in long at the price that you want. So therefore, you have to trade smaller, further away from your stop price in order to participate in that trend. This is why I also think that having micros is a great tool as a trader, because maybe you're trading the big E-mini S&P or the big NASDAQ. You could actually go to the micros on these trend type days and scale your way into the same contract size, position size that you may want, but you're not as price sensitive. So in bull trends, buying at and above price on my scales. And if I want to be short in a bull trend, I'm selling at and above the price. So if I have resistance and an up day in the NASDAQ, which is in the bull trend right now, the strongest market out there, I am not selling at or below that price. I am waiting for the market to get to that price, and I'm selling at and above that price. And when the market comes down, for me to cover that position, I'm buying at and above that price. So the same thing goes for when you're covering a short in a bull trend. So psychologically, I'm already creating patience when I'm going against a counter trend. And when I'm going with a trend, I am taking that patience and making myself less patient. And everybody talks about being patient, but there's a lot of times as a trader, you want to be impatient. And the reason is because sometimes in a trend day, which we see a lot, you need to start your position a little bit early because you're going with the trend and you have confirmation with it. And you want to be more patient when you're going against a trend. And the same thing will go for a bear market. So think about this psychologically. In a bear market, what do you want to do, everybody? And if I'm going to look to get short, I want to sell at and below my prices in a bear market. Let's talk about gold. I think gold is a weak market. I want to sell at and below my entries, and my range of execution is going to be starting below my resistance. And if I want to look to get long, I'm going to buy at and below it. And the same thing goes for how I talked about exits, except just in the reverse, the way I explained it for a bull market. And so psychologically, you put yourself in a stronger hand position in the market because you are allowing the market to do what it's going to do, and you're adjusting your execution based upon it. And so, Tom, maybe we'll bring you back in here now And that simple rule that I went over really was a game changer for me.
Right. And, it makes a lot of sense when you are trading with the overall trend. You're using that trend to basically say, hey, you know what, if we're short in a bear market, it's okay to not get your short price. Yeah, if it gets up there, that's fine. But if you come in and you short a little bit lower than that, that's okay because the market should trend that way. You have a better your probabilities are better that, well, okay, I didn't get the price I wanted to sell at. It's a little bit lower, but we're still thinking that it's going to be a bear market today, so not really concerned. Otherwise, you might miss that move.
Exactly. And this is why I keep going back to the micros is such a great tool for not only very new traders, but for advanced traders, because it allows you to be less price sensitive. It allows you to get in the market in their range. And so many people are caught up in, trying to be too big or trying to catch the move too fast. And they're ultimately looking for the outcome to happen so quickly that a lot of people are all in and then potentially all out. And they're trying to, in some ways, force their will on the market. And that just doesn't work. And I know for my own self that every time I try to be all in too quickly and too much at one price, most of the time, if the market's giving that to me all at once, you probably don't want all of that. So let's go to the charts actually today. I think we need to hop in here because I want to show examples of a scenario. I think today's a really good day to look at this and to understand on a day like today why you'd want to be more aggressive selling gold right after the open because of a few reasons. Number one is, if you remember when I did the gold show, it was just last week, and I talked about how I've been very bearish gold. It's really been the only market I've been trading. I'm not trading equities too much right now at all. I really didn't even trade much of them at all last week, only because gold is the market of choice for me because everything is clear to me. And you can go over that what I talked about in that last show, and I'll give you a quick kind of overview of why that is. And when you look at gold, it's been below. We talked about breaking out these recent lows. We talked about below the VWAPs. We talked about the Bollinger Bands opening up like a mouth. Here's a daily chart. Look at this RSI. If you remember back when I talked about gold, I said you could start to see it potentially get to oversold. And I drew this trend line and I said, you know what? I'm not gonna stop selling gold until two things happen. One is we test this trend line. And if everyone remembers that horizontal line that I drew was unfinished business, which came in this old VWAP, which was like right around 1941, 1942. Okay. And I said that a lot of times when the market comes out away from an old VWAP, and these order flow VWAPs are connected to the beginning of every month, and the market starts to look like a trend is changing, it goes back and tests that volume weighted average price. And that's when finally you start to see maybe that trend comes back into play. And today, I think you have a huge test for gold. We'll see how it goes. But ultimately, I said we're basically, in some ways, some of you may look at this almost as like a gap, right? A gap to the volume weighted average price. And, I actually filled it today. And I've been short. I've been actually using micros for these positions because I was kind of getting stopped out the other day when equities were starting to rally or break, and then gold rallied. And so then to this morning, it's funny, even in our room, when we talk about this on Place Your Trades, everyone was talking about opening range in gold today and why that triggered a short. So a lot of day traders were coming in and saying, oh, let's look at gold as a short today because what it triggered on the open. A couple things I want to talk about too before I get to the shorter term chart to explain a range of execution short is, first off, you have to kind of know where your targets are. And when you look at these Bollinger Bands, I talked about the 60-minute Bollinger Bands, also unfinished business. When you have a Bollinger Band peak, I draw horizontal lines at those levels. And you could see here that we went down and kissed that today. And so you also have the test of the daily VWAP that was like I said, basically a gap right around 1941-ish. And you have a day today where we go down and hit the 60-minute Bollinger Band peak. So a lot of signs are telling me that if you've been short gold, you kind of want to be out of it. And so I just wanted to kind of talk about that for a second. And then when you get to the short-term charts, this morning we were all talking about this in our Place Your Trades chat. Opening range. So when you look at gold, a couple things I want to show here that's different than equities And this is where we're going to get into the example of when you want to sell at and below stuff. So first things first, you look at the order flow VWAP. I'm going to click on this and I'm going to give you an idea of what we're looking at. So what I do for gold, which is different from the equities market, is really just change. If you see your drop down right here, you're going to see trading hours. So a lot of times you guys have noticed that I use regular trading hours for the VWAP because from 9:30 Eastern until 4:15, when the futures have the primary trading hours, that to me is the time I want to have the order flow VWAP on a 3-minute chart. For gold, I take that to the FX futures, and it takes it back to the 8:30 time frame, 8:20-ish, really, and that'll show you really where that opening range is for gold, and that's something that I'll use more frequently, actually only when I'm looking at gold, silver, or any sort of FX market. I don't use the regular trading hours open for the indexes because if you were around during the pit days, you realize that euros and gold and all those other markets opened up before us. And so this is still triggered back to those times because I think that during those times, you still have the volume surges starting earlier before equities, and gold and currencies are definitely more global markets. And those markets are going to be heavily traded a little bit earlier than equities. So I started off a little bit earlier. When we look at that now that I've clarified that, you see this morning opening range, the high of the day in the 3-minute, I have that boxed out. And then we start to sell off. And one of the things that I look at, and I've talked about this a lot, is when you get below that opening 3-minute low or get above that opening 3-minute high, and then that VWAP gets below it, that is an indication of a trend down day. So what did I say from the beginning today, everybody? Identify if it's a bear trend day, a bull trend day. We already know I've been bearish coming into gold. The days that I love the most are when I have a bear market trend on a daily or a 60-minute chart, and you get into the short term, and right out of the gates, you have opening range, 3-minute for me, and you have this violation to the downside, and it's indicating that we're a trend down day. Now you want to be very impatient getting short. You want to sell at and below your areas. And because I don't use traditional support and resistance, a lot of times what I'm looking at is just using the VWAP or the standard deviation lines around an order flow VWAP pinned to that opening bar. So what I look for is on a trend down day in a bear market, any retest of the VWAP with a stop above the standard deviation, the one standard deviation, is the play for me. Because now I'm actually going to believe in the VWAP as an area to where if we test it in a downward day on a 60-minute and an opening range high on a 3-minute breakout with the VWAP, I need to be in short, and I need to be in short quickly. So immediately, once this VWAP gets below this 3-minute and this 3-minute horizontal line, and the market gets below it, I start working orders to VWAP, and I work them one standard deviation out, and that's what we were talking about this morning in the trading room. My brother Pax was talking about he trades more in the opening range. And for me, I trade it right off of that VWAP because it gives me really a stop. I'm working one standard deviation away from the order flow VWAP. And to me, I'm selling at and below. And anytime we hit it and break, selling more, right? And then you're looking for your 1, 2, or even 3 standard deviation areas as targets. And now it goes back to this. What are you looking for on a downtrend day in a market that's bearish and also is bearish on your opening range? You're going to try and get, and I kind of hate the word greedy, but it also is something that I think about. I need to take when the market I think is giving. So in my mind, it's not that I'm trying to get greedy, but I'm thinking I have what I want now. I'm getting in and I'm going to get in aggressive at or below my areas. And I'm also going to try and buy at or below on my covers. So one standard deviation moves are very small trailers where you cover, and you're going to continue to look for that 2 standard deviation move, or you're going to look for your bigger picture target when you go back to gold and look at the daily here, and then you go back to look at, or that was a 60-minute and the daily there. And now the trade is done. And now it's done because today is a day where you got, I think in some ways, that little bit of a mini capitulation in the market. And this is the day where you needed to capitalize on it. And all these other days I talked about it. I've actually gotten nickel and dimed several times in gold today was the best day I actually had in gold. And really, I look at it and say, this day made up for all the times that I got nickeled and dimed. And it's just because that today was finally the day where it showed you everything. And I was like, wow, it finally hit my target. It hit everything. And now, you're flat and you wait. And so, Tom, I'll bring you back in. And like, I really feel like, everything is kind of led up to this moment. It's a great day to talk about this. Everyone knows, if you follow me on social media, the only trade I've been looking at is bearish gold. It's the only market I've been trying to stay in short every single day. And when you finally see this, you're like, going, oh, I need to get in and need to get in. And believe me, what I tell you, in some ways, I wish I got them a lot better than I did. But that's a whole nother show and a whole nother story, because sometimes the moves happen so fast that you almost can't even really take advantage of them the way you want. But ultimately, hopefully you understood from that example of how things set up, and eventually you get something that you were really looking for, and it pays you.
Yeah, and then what I love about this is, the target you've known in one sense for 2 months.
Yeah, I've
right?
known about it for a while. Yeah.
Right. And I know you've been talking about gold for this entire month, it seems like.
Yeah.
This has been your trade. And then having that confirmation on the 60-minute chart. I should say confirmation. It's not really confirmation. It's almost just a little more evidence to say, okay, that level that we saw with the gap we're trying to fill, the Bollinger Band is giving us a little more confirmation. So in your mind, you have a target should the market go that way. And early on, it seems, okay, well, this could be the day that we get to that target. I like the way that you blend in. Your entries are different from your targets, right? You're getting a different indication on why it's a bearish day today, almost right out of the bat. You're 10 minutes into maybe 12 minutes into the market.
Yeah.
And you got that cross below. And then you've got in your mind, you've got this target below. Boy, that's a great setup and a great target.
Absolutely. And you go back, I'll actually go back to show you here on the 60-minute chart, where like the perfect example of a day where here's the 60-minute. Yeah, you go back and look, a lot of times I was getting nickeled and dimed when we started getting back above the over. This was actually, I was continuing to try and stay short overnight. And every time you had these down moves in equities, you had these fierce rallies in gold, and you're like, I'm trying to stay a lot of times in swing positions. I'll look at 1 or 2 standard deviations above the VWAPs on the 60-minute, still sessions, and you're just getting trailed out of stops, and you're like, oh man. And then you got to wait for the next day in opening range to come back in, and then ultimately that happens. And so, and that's just about risk management, right? I mean, because it's funny. I was watching this Conor McGregor thing on Netflix. I don't know how much anybody out there watches UFC, and people kept talking to Conor about his losses. And he's like, man, he goes, this is a hard business, man. He goes, I've taken tons of losses. He goes, that's just what happens. And eventually, like, you see the guy at the end, I'm episode 3, I think, where like he's kind of changed the way he is as a person. Like after he had that one loss, where he really hated the guy. I think his name was Habib. I'm not 100% sure. Anyway, it was like he tried to force his will so much on that, and he lost. And after that, it was like it almost triggered to him to realize that, look, I'm going to go in there. I'm going to have fun doing this. And obviously that's a sport. We try to have fun with trading as well, although sometimes it may not be. But the moral of the story is that you're going to get nickeled and dimed, or you're going to have a lot of stop losses in this business. And I go back to this gold trade. I've been trying to be short gold for literally the last 3 weeks. I've gotten stopped out probably more times than I've taken profits coming into a day like today. And so the point of that is eventually you're just in the position where you're like, okay, today's the day, it's got to happen. And everybody talks about always being so patient. But if you're not impatient in a time where it gives you what you want, then that whole time you're getting beat up is for nothing. And that's why I use ranges of execution, because if I know I want to be short and I know that this is the opportunity, and you go back to that Conor McGregor where he sees that opportunity, right? He knows he's in that fight, he's in that, he's in that ring, and all of a sudden there's that window to take a guy down. He's got to do it right then and there, because if he doesn't, that guy is going to get him the next time. That is what's going to happen. And so you have to constantly be present to be able to be in those positions to win. when the market presents itself to you. So it's like, I'd love to say and go back and say, man, I just cleaned up being short gold the last month. It's not the case. The case is that I got doing it and trying to get in, and eventually 1 or 2 days makes up the whole time I was trying to be short. And you're like, why am I even doing this? Sometimes you question it, right? But ultimately, that's what happens. And so I think that when you look at a range of execution and you talk about risk management, it goes 2 ways. One way is you're going to get stopped out. It's going to happen. You have your ranges. You're committed to your price action. If I want to be short, I'm going to be short at and below prices in a bear trending market, but I'm going to work my stops. And if they get me, they get me, and they might keep getting you. But eventually, when it starts to go your way, and I guarantee every trader out there can relate to this, and eventually that move starts to happen, and you say to yourself, here's the day, and then you don't get in. Why did you not get in? You didn't get in because at that moment, the market didn't give you the opportunity for the retracement that you wanted. So ultimately, the move happened. And it happened to me so many times in my career, where eventually you start to realize that if I don't become impatient and stick to to these skills that I talked about, really these tangibles with this range of execution, I need to step on it at and below in a downward trending day, because today might be the trade that ultimately I really need to take a position on, because who knows, it might get that level I've been waiting for today. And you have to keep putting yourself in that position and managing your risk to getting stopped out, to eventually, when it does happen, you make more money than you've lost. And that to me that's trading.
Well, that makes a lot of sense. And, it's on paper, it makes a lot of sense. It's probably a little bit harder when you've been shorted or stopped out, I should say. When you're shorting and it goes the wrong way and it happens, like you said, you've been nickel and dimed, you've been stopped out. It's something you have to get over, right? It's an instinct that you have to think about. You have to be cognitively aware that, look, I have to do this. I can't be once bitten, twice shy. I have to get in there and do this.
Exactly. I go back to this chart. I got stopped out above this high. I was so flippin' pissed because I had been short in a great spot. And I ended up getting short gold, probably, I think after all of it, 20 something points lower. And I'm like, this is unbelievable. I'm like, I cannot even believe I got tripped out. But if I didn't get tripped out, stopped out, the loss would have been far worse. And then when all of a sudden it started happening again, I'm like, well, you know what? You just got to do it. And ultimately, that's just part of this business. That is just part of this business. You are never going to get a move totally clean. And especially for me, as I move more into swing trading, and I'm not trying to be intraday as much. I'm trying to be, I try to get more aggressive. My positions are intraday, but I always try to keep a little something on in case the move happens overnight. And so I'm always constantly trading around a core position. And it can be really frustrating because you're like, why? Why did I keep this one? Oh, why didn't I keep more? I mean, this is the things we're always going to ask ourselves. It's part of this game. But when the market shows you something, and this is why that range of execution, my last thing before we go to Ask DYE, the range of execution is so important, is because it triggers something in my mind. If I want to be short gold and it shows me something on the chart where it's bearish today, and it's been bearish on the 60, it's been bearish on the daily, and I don't get in short, shame on me. Shame on me. Because I'm not going to wait for that full retest and be patient for that 1 standard deviation move, or wait for a retest at the bottom of opening range. You're probably not going to get it. And the day that I don't do it is the day that it will happen. And we all know. And then all of a sudden you're like, I just been short gold for the last 3 weeks and I made nothing. And there's nothing worse than that. I'd rather make a little something after all of that than nothing. And that's just part of this business.
Amen. Love it. Thanks, Anthony. Want to go right to the question today. Ask DYE. Submit your questions on Twitter with hashtag Ask DYE. And this week's question, Lear Taste. How can I avoid bad decisions and learn to be more patient? So I'll let you answer that, Anthony.
Hey, buddy, will you send me a message on how to do that? Look, I make as many mistakes as anybody out there. And I look at it like this. All you can do is put, number one, you have to have a set of rules for a strategy. That's number one. And I think you need to differentiate rules and like guidelines and instincts. What I have here today that I talked about, a range of execution, is something I put more in an instinctual category, meaning that we all know when we're doing something wrong. That's not really a rule based in our strategy and the technical aspect of it, but we understand a situation where we have to look at the market and say, I need to take advantage of this. I need to step in and do something here. Right. And so I look at it as we all know what's right and wrong. And so you have to have rules on a strategy, and you've got to build instincts around that strategy that help you become a better executor and really just minimize your bad decisions in the moment, right? Like if I go back to real quick, like with a day like today in gold, if I had a long setup and a bear day, I would not be stepping in aggressively in that, because I already know, let's just say I missed a short and it got to support. I would never be aggressively in that position, and that would be a stupid move on my part. So even though I do think that gold probably held support and maybe we could see a decent bounce from here, I'm not going to step in and get long, because I know what I've been looking for and waiting for. And so I eliminate the bad decision. And that's just something that we know inherently. And it's something that we as traders, we develop those instincts and that self-awareness over time. So there is no really black and white answer to that, but it's just about doing things and learning from things and putting yourself in better positions mentally in the moment in the future.
Thanks for that, Anthony. I do want to remind everybody that if you do send a tweet to ask Anthony for future shows, put in that hashtag AskDYE and make sure you're following @NinjaTrader, so that if we do use your question, we will send you something nice as long as you're in the United States. Again, that's AskDYE hashtag. Throw that in there. Thank you so much, Anthony.
Thank you, everybody. And just the last thing, if I could show the chart real quick, I want to remind everybody, we keep talking about gold. If you just Google CME Group Gold Challenge, you could find this there. It's June 4th to the 9th. If you follow me on Twitter, if you follow me on any of the social media, or if you go to anthonycrudelli.com, you'll see some information coming up on this precious metals trading challenge. The winner actually is going to get a 1 ounce bar of gold, which is awesome. And it's free to register. And I think it's a great way to go and test yourself in the gold market, see how other traders are doing in this market. And I'll be doing daily videos for CME Group and all the participants about gold. And so hopefully you can join in and check it out.
I love it. That looks exciting. Looks like there's some bars of silver there, maybe a runner-up prize. I don't know, but let's go for the gold, right? We want
Let's go
that.
for the gold.
All right. Well, thanks, Anthony. It's been a great half hour, and we will do this again next week, same time, 10:30 a.m. on Thursday for Develop Your Edge. Any plans this weekend? 3-day weekend for you? Golf. I knew it. I knew it. That's awesome. That's great. Well, thanks again, Anthony. How can people find you real quick?
At Anthony Crudelli on Twitter, anthonycrudelli.com, and placeyourtrades.com. Go check out placeyourtrades.com. Got a lot of cool stuff going on there. A lot of podcasters talking about futures markets.
Awesome. Thanks so much, Anthony. And thanks to all you viewers for sticking around and watching this program. Mike Burke. Today it's Mike Burke. Anthony, your friend Mike Burke will be closing out the day with bars closing at 3:15. Hope you can join us. In the meantime, have a great trading day.